Welcome to the deep dive. Today, we're diving into, well, it's pretty fascinating, actually, the Federal Reserve's own internal review of what caused the Silicon Valley Bank to collapse. And this isn't just about, kind of recapping what happened, but like, what did the Fed itself think went wrong? And, what are they maybe going to do differently going forward?
Yeah, you gotta. We're going like beyond just the headlines here and really kind of dissecting the Fed's own self-assessment of where they think, maybe things went wrong. It's kind of a rare look into, how a powerful institution like this thinks about its own missteps.
Right. Yeah. And so just to set the stage, let's kind of rewind back to Silicon Valley Bank, SVB. And, they were obviously very embedded in the tech world, right? They were kind of like a go-to bank for startups and all those venture capitalists.
Yeah, exactly. And I think that's important because SVB's growth was really explosive between 2019 and 2021. I mean, they basically tripled in size. They were holding like $212 billion in assets by the end of 2022. And a big chunk of that was invested in these long-term securities, things like government bonds and mortgage-backed securities.
Right. So imagine you're holding all these securities,
Yeah.
you're thinking they're going to mature way down the line, and then suddenly interest rates spike up like they did in 2022. What happens?
Well, basically, the value of those securities just takes a nosedive. And SVB was using this accounting practice called held to maturity, which basically let them just kind of ignore those losses, at least on their balance sheet.
Oh, so they were kind of sweeping the problem under the rug for now. But the Fed's report actually points to an even deeper issue. They kind of identified four major factors that led to SVB's downfall.
Yeah, and it's almost like this domino effect. The first domino was SVB's management. They really failed to manage the risks, and specifically the risk of having this very concentrated deposit base that was largely uninsured, coupled with that massive long-term securities portfolio.
So they were kind of playing a pretty risky game with a lot of money that wasn't backed by the FDIC.
Hmm.
What tipped over that first domino, though?
That brings us to domino number two, supervisory failure. So as SVB grew so rapidly, supervisors at the Fed didn't really fully grasp, I guess, the vulnerabilities of the bank. It's like trying to, steer a speedboat that suddenly becomes this giant cruise ship.
Right. Recipe for disaster. And it sounds like even when the supervisors started to see some cracks, they weren't exactly quick to act.
Yeah, unfortunately, that's domino number three. The Fed's review actually admits that they were too slow in making sure that SVB was actually fixing the problems even when they saw them. For example, take interest rate risk. The report highlights that supervisors had been raising concerns about this for years, but actions were delayed. They often waited for more evidence before taking any steps.
So it's like seeing a leak in a dam, right?
Right.
You need to fix it, but you just wait and hope it doesn't get worse, and then suddenly there's a massive flood.
Yeah, that's a good analogy. And then the final domino number four is like a 1-2 punch. So the Fed had adopted this tailoring approach, which basically meant they were easing up on regulations on some banks to reduce the burden. But this, combined with a shift towards less assertive supervision, actually ended up making it harder for them to oversee SVB effectively.
So good intentions, but, kind of gone awry.
Yeah.
But what does this all mean for, like, the average person? Was this just one bank making a bunch of bad decisions, or is there a bigger lesson here?
That's the million-dollar question.
Sure.
The Fed's review acknowledges that this tailoring approach might have actually masked risks at other institutions too. Remember that example of interest rate risk? Well, one specific rule that was tailored actually allowed SVB to avoid having to fully account for the potential losses on that securities portfolio.
Oh, wow. So a seemingly minor tweak to a rule could have these major consequences. And what if SVB wasn't the only bank doing this kind of risky stuff?
Exactly, and that's why this Fed review is so important. It's kind of like a wake-up call, not just for regulators, but for anyone who wants to understand how these seemingly isolated events can have ripple effects through the whole financial system.
Yeah, it's like that butterfly effect.
Yeah.
One small change can lead to these huge consequences elsewhere. But let's zoom back in on SVB a little bit. Were there any specific examples of how these failures played out in real time?
Absolutely. Let's start at the very top. SVB's board of directors. Now, you would think they'd have this really clear view of, what the bank's risks were, but the report says that they were getting inadequate information.
So the people at the helm were basically steering the ship without a compass or a map. It's kind of terrifying.
Yeah, imagine trying to make these critical decisions without knowing, what's going on around you. For example, they weren't properly informed about how much exposure SVB had to interest rate risk, even though internal metrics were showing that they were exceeding their limits for years.
That's mind-boggling.
Yeah.
Do you think the supervisors at the Fed knew about this communication breakdown at SVB?
They did it. Supervisors actually noted that there was a lack of effective challenge from the board and that they had more of a reactive approach to risk management instead of being proactive. But as we discussed, their response was, delayed.
Okay, so problems at the top.
Yeah.
What about the bank's ability to handle a sudden rush of withdrawals? That seems pretty crucial for any bank, right?
Oh, yeah, absolutely. That's where liquidity risk management comes in. And this is where things get really interesting. The report highlights that SVB's reliance on these uninsured deposits was a massive vulnerability.
So if a lot of people suddenly wanted their money back, SVB might not have been able to give it to them.
Exactly. And what's even more striking is that the supervisors actually knew this was a problem. They repeatedly found weaknesses in how SVB was managing their liquidity risk, and they issued warnings and findings about it.
So they were seeing red flags, but
But they didn't really connect them to the ticking time bomb. The report says that despite all these warnings, supervisors still thought that SVB's liquidity was adequate overall.
so they were basically saying everything's fine while this potential crisis was brewing.
It seems that way. They were more focused on how SVB was managing things rather than, the underlying issue of having so much uninsured money. And then that brings us back to the investment portfolio and all those long-dated securities.
Ah, yes, the ticking time bomb. So as interest rates climbed, the value of SVB's investments went down, and then their depositors started to panic.
Yeah, it's like the classic recipe for a bank run. The Fed's review acknowledges that, SVB's investment strategy just totally backfired and led to these massive unrealized losses. And while supervisors did have some concerns about their interest rate risk management,
We're too slow to act. It seems like a bit of a pattern here.
it is. It's a recurring theme in the report. Their actions were often, limited and didn't really get to the root of the problem.
So we've got management failures, supervisory delays, and a regulatory system that wasn't really keeping up with the realities of, this fast-paced tech industry. But SVB wasn't alone, right?
That's the scary part. The Fed's review raises these concerns about, the whole supervisory and regulatory landscape.
So it's not just about SVB. It's about the potential for these same issues to be lurking in other places.
Exactly. The Fed is now realizing that their approach with tailoring, while it was meant to, reduce the regulatory burden, might have actually created these blind spots in their oversight.
Okay, so we've kind of set the scene and unpacked these 4 big takeaways from the Fed's review. Now I think it's time to dive even deeper into the review itself and really see what specific actions they're considering. Are you ready?
Yeah, absolutely. I think this is where things get really interesting. It's like we're putting together a puzzle where each piece is, a failure in risk management or oversight. But, by understanding where the pieces went wrong, we can figure out how to build a more resilient system.
I love a good puzzle. So lead the way. Okay, so we're kind of putting together this puzzle of, what went wrong at SVB. But the Fed's review isn't just about, pointing fingers. It seems like they're really trying to figure out how they can improve going forward.
Yeah, I think you're right. They actually kick off the report with a pretty stark admission. They recognize that they need to strengthen their supervision and regulation, and they're taking ownership of their role in, what happened with SVB.
Wow, that's a big step,
Yeah.
right? For an institution like the Fed, it would be easy to just say, hey, it was all SVB's fault.
It would. But I think, taking that hard look in the mirror is crucial for them to rebuild trust. And one of the key takeaways is that, strong bank capital really matters. Remember that while the immediate cause of SVB's failure was, a liquidity run, everyone rushing to get their money out at the same time, the underlying issue was really concern about their solvency.
So even if they could have met those withdrawals, there were still doubts about whether SVB was actually financially sound to begin with.
Exactly. And here's where I think things get really interesting. The report really stresses that the Fed needs to be constantly evaluating its own playbook and being humble about, its ability to spot new risks. I mean, the financial landscape is always changing, so they need to be able to adapt.
So no more, set it and forget it approach to regulation. It's
Yeah.
got to be more dynamic.
Right. And they're not just thinking about, specific risk drivers like interest rate risk or liquidity risk, but they're talking about really bolstering resilience across the entire financial system.
Okay, that sounds pretty monumental.
Yeah.
What are some of the specific actions they're considering?
Well, some are already underway. They're reviewing their capital framework. They're implementing these international banking rules known as Basel III. They're running, more diverse scenarios and stress tests and even developing a new rule about long-term debt, all to make those larger banks more resilient and easier to kind of resolve if they get into trouble.
A lot of jargon there, but it sounds like they're really trying to tighten things up.
Yeah, that's the gist of it, but there's definitely more to come. The report outlines, a whole set of additional changes that were specifically spurred by the SVB meltdown, but we'll have to wait for those details to be released.
Interesting. So this isn't just a theoretical exercise. They're actually planning to change how they do business. Where do they even begin, though?
I think the first area they're focusing on is speed and forcefulness. The Fed admits that, their tailoring framework and that less assertive supervisory approach actually contributed to their delayed response with SVB.
So in other words, they weren't assertive enough in dealing with SVB's problems. It seems like a pretty big change from their previous approach.
It is. It's definitely a shift.
Yeah.
In SVB's case, their rapid growth combined with that slow transition to stricter standards basically created this lag in, how quickly they were able to identify and respond to the risks. They want to change that.
So if a bank is growing really quickly, then supervision needs to kind of ramp up at the same pace. No more playing catch up.
Exactly. And it's not just about speed, it's also about raising the bar for resilience across the board. It's like, building a stronger foundation for the entire financial system, not just the biggest banks.
So they're widening their focus to make the whole system more robust.
That's right. And to do that, they're going back and revisiting that tailoring framework we talked about. They might add back some of those regulations for banks that have, $100 billion or more in assets.
Makes sense. So if you're a big bank, you might be facing some stricter regulations in the future. What are some of the specific areas they're looking at?
Well, interest rate risk is a big one. Remember, that was one of SVB's main vulnerabilities. The report points out that, SVB didn't manage this risk very well, and supervisors didn't really push them hard enough to fix it.
So back to basics, making sure banks can handle changes in interest rates.
It's crucial. And it's not just about, revisiting how they supervise interest rate risk. They're also looking at liquidity risk, and especially the risks that come with those uninsured deposits. They want to make sure that both banks and supervisors have better tools to, assess and manage that risk.
So no more sweeping those vulnerabilities under the rug. They're trying to plug the holes in the system. What might those changes look like in practice, though?
Well, it's early, but they're considering a bunch of different options. They might reevaluate how certain securities are treated in their liquidity rules or how they measure the stability of uninsured deposits and maybe even, whether to apply standardized liquidity requirements to a wider range of firms.
A lot to unpack there, but it sounds like these changes, if they actually happen, could have a pretty big impact on the banking industry.
They could. But it's important to remember that any changes to these rules would have to go through this whole long process, getting public feedback, setting appropriate transition periods. So it's not like we'd see these changes happen overnight. It would probably take several years.
Okay, so buckle up for the long haul.
Yeah.
What else is on their agenda?
Capital requirements are another big one. They're trying to find ways to make those more robust, maybe requiring banks to hold even more capital to act as a buffer against losses.
So essentially building a bigger cushion to absorb those financial shocks.
Exactly. For example, they're thinking about requiring more firms to factor in any unrealized gains or losses on certain securities. That would give them a much clearer picture of the bank's true financial health.
It seems like transparency is a recurring theme here.
It is. But again, these changes wouldn't be immediate. The rulemaking process takes time.
Yeah. Patience is a virtue, I guess.
Yeah.
What about stress tests? Those were a pretty big deal after the 2008 financial crisis.
Oh, yeah, they were, and they're still a crucial tool, but the Fed recognizes that their tailoring might have made them less effective. So they're looking at ways to make sure the stress tests are really comprehensive and, really put banks through the ringer.
So making sure banks are ready for the worst case scenario. What about the human element in all this, though? Are they looking at how, bank managers are incentivized?
That's a great question and a really important one. The report actually found that, SVB's senior management was responding to the incentives that were set by the board, which unfortunately didn't really emphasize good risk management.
So the incentives were actually encouraging the kind of behavior that led to the bank's collapse.
It's kind of a sobering thought, right? The Fed is considering whether to implement stricter standards for incentive compensation programs and also making sure banks are actually following the rules that are already in place. They want managers to be rewarded for, responsible risk management, not just focusing on those short-term gains.
Okay, so reward good behavior, penalize bad behavior. That seems pretty basic.
It is, but sometimes it takes a crisis like this to remind us of those basics. And that brings us back to SVB and, their dramatic rise and fall. It wasn't just bad luck. It was this whole combination of factors, some internal, some external, all kind of converging at the worst possible moment.
And the Fed's own actions, or sometimes, inaction, played a role too.
Exactly.
Yeah.
Their review is this really candid assessment of their own missteps and It's also kind of a blueprint for how they plan to do better going forward.
So let's rewind a little bit and retrace SVB's journey. Paint us a picture of how this bank went from being this relatively small player to this giant in the tech world.
Well, SVB started out small with just like $18 million in assets back in 1983, and it grew steadily over the years. But then between 2019 and 2021, things just went into hyperdrive. Like they hit the fast forward button.
That's when the tech boom was really taking off, right?
Exactly. SVB was riding that wave, and their main client base was all those venture capital-backed companies in tech and life sciences. And as those companies got more funding, all those deposits were flowing into SVB.
So SVB was in the perfect position to benefit from that surge in tech investment. But it wasn't just about their client base, was it?
No, the low interest rate environment during that time played a huge role too. It amplified the effect of all that cash coming in, and it led to what they called an exceptional year of growth in 2021.
So kind of like the perfect storm of favorable conditions for SVB,
Yeah.
but all good things must come to an end. What happened when things started to change?
Well, that's when those underlying vulnerabilities really started to surface. In the latter half of 2022, venture capital activity started to cool down significantly. Investors got more cautious as interest rates rose, and people started to worry about the economy. And as the funding for SVB's clients slowed down, so did those deposits.
Like someone flipped a switch, suddenly the music stopped and everyone was scrambling for the exits.
That's a great way to put it. And remember, a huge chunk of SVB's deposits were uninsured. By the end of 2022, like 94% of their deposits weren't covered by the FDIC.
Wow, that's a lot of money just hanging in the balance. So
Yeah.
what did SVB do with all those uninsured deposits?
Well, they decided to invest a big portion of it in those long-dated securities we talked about earlier, mainly mortgage-backed securities. They were betting that interest rates would stay low, but that bet really backfired.
And that's when things really started to unravel.
Yeah.
As interest rates climbed, the value of those securities went down.
Yeah, and to make matters worse, SVB's business model made them even more vulnerable. Their securities portfolio as a percentage of their total assets was more than double that of your average large bank.
Hmm.
And remember that held to maturity accounting practice, while their HTM portfolio was also almost double the size of the average bank.
So they were taking on more risk and using an accounting method that was kind of hiding those risks, a dangerous combination.
Yeah, and then you add in their reliance on those uninsured deposits, which was more than double the average for large banks, and you've got a recipe for disaster.
It's like they were walking a tightrope without a net.
Hmm.
So as 2023 rolled around, things started to unravel pretty quickly, right?
Yeah, they did.
Yeah.
Deposit outflows really intensified as SVB's clients started burning through their cash reserves. And then there was that Financial Times article in February 2023 that really highlighted SVB's risky securities portfolio, and that just kind of added fuel to the fire.
So now the press is starting to get involved. Investors and depositors are getting spooked. It's the classic bank run scenario.
Exactly. On March 8th, SVB tried to, kind of shore things up. They announced a restructuring of their balance sheet, sold off some securities, which resulted in a pretty big loss, and said they were going to try and raise more capital.
Sounds like a pretty desperate attempt to regain control. Did it work?
No, unfortunately not. The announcements actually backfired, and it created even more panic among their depositors. By March 9th, they had this massive outflow of over $40 billion.
It's like trying to put out a fire with gasoline. I'm guessing social media didn't help.
No, not at all. Rumors were just spreading like wildfire, amplifying all that fear and uncertainty. The Fed and other regulators tried to step in, but it was too late. By March 10th, SVB was closed and placed into receivership.
The end of a pretty wild ride. But what's really interesting is that the Fed isn't just looking at SVB's missteps. They're also analyzing their own oversight of the bank.
Yeah, you're right. The report acknowledges that the Federal Reserve's supervision of SV was inadequate, While supervisors did flag certain issues, they underestimated others, especially during, that period of rapid growth.
So like a doctor failing to diagnose a patient correctly, even though they were seeing some of the symptoms.
Yeah, that's a good analogy. And they're trying to figure out, why that happened. One factor they point to is a shift in supervisory policy after 2018 that kind of emphasized reducing burdens on firms, requiring stronger evidence from supervisors, and ensuring due process for firms that were, facing actions.
So maybe an overcorrection after all those stricter regulations that were put in place after the 2008 crisis.
It's possible, while those changes had good intentions, they might have actually made it harder to effectively supervise SVB.
Interesting. So sometimes even good intentions can have these unintended consequences.
Yeah, exactly. And there were other factors too. The COVID-19 pandemic, for example, led to a pause in some bank examinations, including those for regional banks like SVB.
Yeah.
And that pause just happened to coincide with SVB's, massive growth spurt, which created even more challenges for supervisors.
So the pandemic really created the perfect storm for oversight to falter.
It did. And then there's also, the internal structure of the Fed's supervisory process itself. The report highlights this potential conflict of interest within that structure where, staff at the regional Federal Reserve banks might be inclined to defer to staff at the Federal Reserve Board even when they have concerns.
So a bit of a bureaucratic tangle that might have slowed down the decision-making process.
That's one way to look at it. The Fed is now exploring some potential solutions to address these issues and improve, the effectiveness of their supervisory program.
So they're recognizing that their own internal structure might have contributed to the problem.
Yeah, it's a step towards accountability. And it's not just about structure. It's about, understanding how their supervision played out in relation to SVB's specific risk areas.
That's like a good place to pick up in part 3.
Absolutely. We'll dive into, the specifics of their oversight of SVB's governance, their liquidity risk management, and their interest rate risk management. That's where we can really start to see how these failures played out in practice and, what lessons can be learned.
All right, so welcome back to the deep dive. We've been on quite a journey, tracing SVB's rise and fall, dissecting the Fed's role in all of this. And I think it's time to kind of zoom in and really look at, the Fed's supervision of these key risk areas at SVB, kind of those pressure points that ultimately led to the bank's collapse.
Yeah, exactly. Let's really examine, the Fed's oversight of SVB's governance, liquidity risk management, and interest rate risk. I think this is where we can really see those abstract concepts we've been talking about actually play out in the real world.
Right. Okay. So starting with governance and risk management, these seem like, pretty basic foundational elements for any bank.
Absolutely. And the Fed's report basically says that, SVB's practices in these areas just didn't keep up with their rapid growth. It's like they were trying to build a skyscraper on a foundation that was meant for a 2-story house. The board of directors and the risk management team just didn't have the experience or the capacity to handle a bank that had tripled in size in just a few years.
So they were kind of in over their heads. What were some of the specific things the Fed identified as issues?
Well, one of the biggest red flags was this breakdown in communication. It's like imagine you're on a ship and the captain isn't getting accurate reports from the crew about, the condition of the vessel. That's basically what was happening at SVB. The report says that the full board wasn't getting enough information from management about, what the risks were.
So the people steering the ship were missing vital information.
Exactly. Like, for example, the board materials didn't accurately reflect how much exposure the bank had to interest rate risk, even though their own internal numbers were showing that they were exceeding their limits for years. And the supervisors also noticed that they had more of a reactive approach to managing risk instead of being proactive.
It sounds like a recipe for disaster.
It was, and the Fed actually calls this an inadequate risk management framework, and they say it directly contributed to SVB's failure.
Wow. Okay. So when SVB did transition to stricter standards back in February of 2021, did that help at all?
Well, it should have, but the transition was really slow, and, the regulations at the time allowed for this pretty lengthy grace period, so the Fed supervisory team needed time to, make their initial assessments.
So while SVB was, sprinting ahead, the supervisors are still kind of getting their bearings.
Yeah, and to make matters even more complicated, the transition to stricter oversight was actually delayed even further because of a waiver that was granted by the Federal Reserve Board. So that meant SVB had even more time to keep growing rapidly without, facing those tougher regulations.
Oh, so it sounds like those delays really might have contributed to SVB's downfall.
Yeah, the report seems to suggest that the Fed is definitely evaluating how they can make sure that their supervision keeps pace with how fast a firm is growing so they don't fall behind like that again.
Makes sense. A crucial lesson for sure. Let's move on to SVB's liquidity risk management. Their ability to handle those sudden surges and withdrawals. That seems like a pretty basic function for any bank, right?
Oh, yeah, absolutely. And this is where things get really interesting. The Fed's report points out that, SVB's reliance on uninsured deposits was this major red flag. Remember, like 94% of their deposits weren't covered by the FDIC.
Right. So if there was a sudden loss of confidence, they could be in big trouble.
Exactly. And the Fed supervisors knew this. They saw the weaknesses in how SVB was managing their liquidity risk. They issued all these warnings and findings. But despite all of that, they still considered SVB's overall liquidity to be adequate.
Wait, so they saw the warning signs but didn't do anything more?
It seems that way. They focus more on how SVB was managing things instead of, that underlying risk of having so many uninsured deposits. It's a disconnect that they're really trying to understand now.
So they kind of missed the bigger picture.
Yeah, and that brings us to interest rate risk, that other major vulnerability we talked about. Remember, SVB had invested a lot in those long-dated securities, which made them extremely sensitive to rising interest rates.
And as we know, those rates did rise, and it caught
Yeah.
them off guard.
Exactly. And the report says that SVB just didn't assess and manage that risk very well. And the Fed's supervisors, while they did see some things that concerned them, were once again, too slow to act and too narrow in their focus.
So kind of a recurring theme here. Delayed action, not really getting to the core issues. Are there any specific examples of that?
Yeah, so the supervisors kept finding instances where SVB was exceeding its own internal limits for this key metric called economic value of equity, which basically measures their interest rate risk. But, those breaches were often kind of downplayed, and the supervisors didn't take strong enough action to make sure SVB actually fixed the underlying problem.
So it sounds like they were treating the symptoms instead of the disease.
Yeah, that's a good way to put it. And there's another really important point here. The supervisors didn't really consider the unique characteristics of SVB's client base, all those tech startups and venture capital firms when they were assessing the risk.
So they weren't tailoring their approach enough.
Exactly. And that's something the Fed is really focused on now as they try to, overhaul their supervisory approach.
Okay, so we've seen this pattern of missteps. Delayed action, not enough resources, and just a failure to fully grasp, how much risk SVB was actually taking. But what happens now? What is the Fed going to do to try and prevent another SVB?
Well, they've laid out this roadmap for reform, outlining several potential changes that could strengthen their supervisory and regulatory framework. They're focusing on enhancing risk identification, promoting resilience, changing supervisor behavior, and strengthening those internal processes.
Okay, so let's unpack those a little bit. Starting with enhancing risk identification. What does that involve?
Well, it's about improving their ability to spot trouble early on. They're looking at ways to use data and technology better, developing more sophisticated models to assess vulnerabilities across the whole system. It's like upgrading their radar system so they can see those little blips on the screen before they turn into massive storms.
So being more proactive in how they monitor the financial landscape?
Right. And they also want to improve their understanding of, specific risks, especially those related to uninsured deposits, interest rate risk, and the unique characteristics of different industries like, the tech sector. It's about really tailoring their approach to the specific risk profile of each institution.
Okay, so better risk identification check.
Hmm.
What about promoting resilience? How do they plan to make the system as a whole more robust?
Well, it's a multi-pronged approach. First, they're revisiting that tailoring framework we talked about, potentially raising the bar for those larger banks that have assets over $100 billion. So that could mean stricter capital requirements, stricter liquidity standards, tougher stress tests, things like that.
So basically building a stronger fortress around those bigger institutions.
Exactly. But they're also looking at ways to strengthen the resilience of individual firms, no matter how big they are. So that includes exploring, additional measures to make sure banks have solid contingency funding plans, especially those that have a lot of uninsured deposits.
So making sure banks have a backup plan just in case.
Yeah, because as we've seen, things can change really quickly in the financial world.
Okay. Enhancing risk identification, promoting resilience, check and check. Now, this next one sounds kind of tricky. Changing supervisor behavior. How do you change the culture within an organization as big as the Fed?
Yeah, it's definitely a challenge, but, the report recognizes that they can't just tweak the rules. They need to foster this more proactive, skeptical, and assertive approach to supervision. They want supervisors to be more forward-looking, to try and anticipate risks, and to act decisively when they need to. No more waiting for a small problem to become a huge one.
So a real shift in mindset from reactive to proactive.
Exactly. And they're also emphasizing the importance of giving supervisors the right training resources and support to, do this more demanding job.
Investing in their people makes sense.
Yeah.
What about strengthening processes? What kind of changes are they looking at there?
So they're considering things like streamlining the supervisory process, improving communication and coordination, both within the Fed and with other regulatory agencies, and, strengthening those accountability mechanisms.
So making sure that whole regulatory machine is running smoothly and efficiently.
Yeah, and they're also really focused on transparency and communication with the public. They want to give banks clearer guidance and build more trust in the system overall.
Yeah, transparency and communication are definitely key. It's about building a system that's Not only resilient, but also accountable.
Absolutely. And it's important to remember that these are really just initial proposals. The Fed is going to be getting input from a lot of different people and doing more analysis before they actually implement any specific changes.
So it's going to be a while before we see any concrete results.
It will, but it sounds like they're taking this really seriously and they're committed to making real changes.
Yeah, it seems like the SVB collapse really exposed some major vulnerabilities, both within the financial system and within the Fed's own supervisory practices.
Mm.
But it also kind of sparked this really important conversation about the future of financial regulation.
It did, and it's a conversation that's going to continue as the financial landscape keeps evolving and new challenges emerge.
Absolutely. Well, this has been quite the deep dive. We've explored some pretty complex concepts, unearthed some systemic failures, and I think, gotten a glimpse of what a more resilient and accountable financial system could look like.
Yeah, it has been a fascinating journey, and hopefully our listeners have found it informative and maybe even a little bit thought-provoking.
I hope so too. Thanks for joining us on the deep dive. Until next time.